Here the view is promised from Dr. Stephen Nash from FIIG Securities, standing by in Sydney. Dr. Nash, good morning to you.
Hi.
What were your takeouts? What were you, if anything, latching onto on the back of that media conference?
Look, I think the Fed is very concerned about the general perception of economic growth in the broader community. I think what they're trying to do is make statements that support ongoing growth. They're realising that the unemployment situation is very serious, and that is really constraining any wage breakout. I think also that the elevated level of oil prices is constraining that growth at the moment, and it may warrant even longer periods of low rates.
You're saying as well that of and in itself could be the catalyst for more bond buying, another QE rollout, QE3.
Look, I think for the Fed to rule out any further quantitative easing is not the right thing right now. They need to remain open to that if that's warranted. So it really depends on how the data comes out in the next little while. I mean, we've had some recent readings on the US property market, again very weak. The S&P Case-Shiller index, again recording quite low or price falls broadly across the US. Property market remaining a problem, not to mention problems in Europe and in Japan.
Stephen, short of a new program of bond buying, QE3, what else is going to happen now by the Fed? People are talking about QE 2.5, but however you want to call it, people expect some support to continue. What form will that take?
Well, I think what the Fed will do is, I suppose, allow the existing program to complete itself. And then as the information comes out, as data is released, maybe add to that program, maybe reinvest some of the coupons in new purchases, that sort of thing, to ensure that quantitative easing is still there. The stock that they have at the moment of bonds is quite high. I imagine that they won't be selling that down anytime soon. I think it really depends on how the information, how the data comes out. And we don't know that at this stage.
Stephen, you flagged unemployment and housing. Watching briefs, we know stuck in the mud territory on both, really, in terms of getting traction to the upside. Is this not just indicative, as our previous guest Jonathan Barrett was wondering, that all the stimulus has been of great benefit to equity markets but not to the broader US economy at all?
Well, I think it's important that they have a strong influence on equity markets. What's happening is the Fed, I think, are conditioning perceptions within financial markets, I suppose, buoying financial markets, and hopefully that will flow through at some stage to the broader economy. But I think, as you say, it's not really displaying itself within the real economy right now. Hopefully we'll see more of that later this year and early next year.
But I mean, we were saying that when they were talking about pulling back from bond buying, if you remember. Yeah. There was an undertaking to do that, and then they acknowledged that they couldn't possibly do that.
Well, I mean, within the Fed right now, there is that hawkish camp, and the dovish camp led by Bernanke and Yellen, I think will control the Fed in the short term. I mean, there's been quite a bit of hawkish rhetoric from other Fed governors of late, so we'll have to monitor how that goes going forward. But there's quite a bit of debate even within the Fed about what to do with policy and with the QE2 program.
There might be a debate, but is it a bit like Warren McKibben at the Reserve Bank here? The lone voices eventually get drowned out and leave the stage. Yeah,
I think Bernanke is just being very, very careful right now. He's very mindful of this unemployment rate and the effect that has on wages. Yeah.
Stephen, one final question from me anyway. We get the minutes then from the FOMC in coming weeks. Is there any extra interest in those, or do we know everything we need to know out of Bernanke now?
I think we've got all we really need to know. I think the thing that markets will focus on is how the FOMC characterise what's going on in the underlying economy, whether they're seeing a broad pickup in economic conditions. I don't anticipate that they will. Again, I'll probably see some pickups in some areas and problems in others.
Stephen, just relating all this back to Australia and observations on consumer prices from yesterday, how did you distill the likely response from the Reserve Bank, I guess, next week?
Well, I think, you know, the CPI has just hardened the views within the market. You've got the hawks out there who are saying that the trend in underlying inflation is now turned, and it's up to the RBA to start tightening as early as next week. The Doves are concentrating more on the budget effects and other problems with the oil price and also the European situation. I'd probably side with the dovish case right now. I think there's room for the RBA to continue to monitor the effects of the flood. We've got a bit of a data blank out with the effect of the flood, and it's really affecting how they're assessing the economy. So it's quite difficult right now for the RBA to really make large calls. They've got to move from a sort of a moderately tight monetary policy to a more tight characterisation of policy. So that's a fairly difficult thing for the RBA to do, particularly if the economy is not performing strongly. So we also need to see what happens with the budget. I imagine the budget will be quite tight.
All right, we'll be across all of that, of course, into next week. Dr. Nash, thank you so much.
Thank you.
Dr. Stephen Nash from FIIG